Hello everyone, welcome back. My name is Arias, and today we're going to be talking about a whole bunch of my favorite companies that have been crushed over the past year. For each of these companies, I'll highlight a few things that I think tell a very different picture from their recent stock performance, and just generally give my thoughts, and then tell you what I'm doing with each company. I'll also somewhat painfully reveal how much I'm down in each of these stocks as well. Don't forget to like and subscribe if you enjoy this type of content, and leave any views, suggestions, and feedback in the comments below. And without further ado, let's get into it. We'll start off with the poster child of this crash, in my opinion, Teladoc. This one is off 77% from the highs reached about a year ago, sitting at an $11 billion market cap. And while my cost base is significantly lower than that of all-time highs, I'm still down about 48%. Now, with performance like that, you'd probably be expecting the company to be on the verge of bankruptcy or something. But shockingly, the management expects the company to grow about 25 to 30% next year. They also have a good bit of cash in the bank, around $800 million at the end of Q3, which at their Q3 burn rate would leave them with at least 9 quarters left of cash. I will also mention that they have $1.2 billion in debt on their balance sheet, which is obviously suboptimal, but this is convertible and most of it does not come due until 2027. I expect them to at least come in at the high end of these expectations that they've given for their revenue guidance, if not exceed the 30% growth, because we know Teladoc's management loves to sandbag. Management is also projecting $330 to $355 million in adjusted EBITDA as well, which is pretty good for a company that's been cut in half twice in the past 12 months. And while you might make the argument that their valuation was ridiculous and it deserved to get crushed, I'm here to make the argument that that was then and this is now, with Teladoc trading at a 4 expected next 12 months price to sales ratio and a forward adjusted EBITDA ratio of 30. Both of these are for a company with margins of 68% and management guided growth of 25 to 30% each year over the next 3 years. Now that I've made the financial case, there were also some good business developments for Teladoc that came out over the past week. The first of which was a launch of a new chronic care product for people with more than one chronic condition. This area represents a massive unmet need and will be important to see Teladoc continue to aggressively add services for this sector. The other bit of news was a leak to Business Insider about Primary 360, and it was stellar. Primary 360 enrollment thus far has doubled expectations internally, while maintaining a 98% consumer satisfaction rating, and new members can still see someone within 7 days. A quarter of P360 enrollees with diabetes or hypertension were new diagnoses, which is central to their strategy of earlier prevention. They are still planning to add on last mile services like at-home vaccination via clinics, preventative screenings, home script deliveries, and broader measurement of vitals to complete this offering. To me, even more jarring than all of the financial and business cases for this company that I just spoke of is that even before COVID hit, Teladoc was still trading about double where it is today. That's before the Livongo acquisition, so there's been a ton of new stock issued. But this was also before the acceleration that the pandemic was for their business. The pandemic drastically accelerated the rate of adoption for telemedicine services, and this has clearly not been reflected in the equity value of the company. Of course, I'm still buying after this week's earnings, and if you'd like to see an analysis video there, let me know and I'll break down the earnings print, the full year guidance, and any takeaways from the conference call. Next up is Beam Therapeutics, the company that has fared best on this list, only down 48% from all-time highs. There isn't too much to say about Beam besides that they appear to be executing well and are moving towards their targets, which are still a ways out. However, their recent deal with Pfizer that I covered in a recent video was a nice interim validation of their technology. I will be interested to see if they can do more of these deals and at what pace and terms they will be at. This will be a good interim tracker of how the industry is rating their chances of success. I've also loved to see their management has started to talk about increased automation. I think this will be a key in scaling the use of their platform going forward. Their acquisition of Guide Therapeutics is something else that has piqued my interest about Beam, and I am intrigued to see if they can utilize this technology to develop LNPs that can deliver targets to other parts of the body outside of the easy-to-target liver. Ultimately, an investment in Beam is a bet on the long-term viability of base editing technology and their management's ability to bring this to fruition. Furthermore, it is a bet that base editing will be superior in many ways to regular CRISPR editing, as Beam is further behind in their development and will need to work to catch up to CRISPR. In this respect, I've never been more confident in Beam. A few recent interviews with CEO John Evans has done an excellent job in this respect, showing me that he is thinking clearly and moving Beam forward with great intangibles. With all of that being said, I fully bailed out my position last year, and I've set an arbitrary price of 50 is where I add more. At that point, I would probably add 25 to 33% to my position. Next up is Ginkgo Bioworks. Ginkgo is down a whopping 70% from the all-time highs, and despite me lowering my cost basis aggressively, I took the brunt of that as well. This leaves Ginkgo with $7.7 billion market cap and, after the SPAC merger, plenty of cash and a huge runway to accelerate their investment to take full advantage of the gargantuan opportunity in front of them. For almost any business to have investable success, there need to be two things: proof of concept and scale. In my opinion, Ginkgo has already showed proof of concept, with a few examples being developing VC production strains that improved yield by 10x for Adelphron, the true Chrono strains that have reached milestone levels and are already going into products, and with Motif, whose protein production strain was developed 70% faster than expected. The second question of scale is one that they have yet to answer. They are putting all of the necessary blocks in place to enable this scale with codebase, using previous projects to streamline future development, and building a state-of-the-art automated laboratories to scale development. We are just yet to see the results of these efforts. In my opinion, the risk of failure versus success and the reward of that success, which is truly massive, is such that Ginkgo is a good bet going forward. On a broader level, as long as you don't use leverage, you can only lose as much as you put into an investment, but you can make infinitely more. This asymmetric risk-reward opportunity is part of what attracts me to invest in these types of companies like Ginkgo, or many of the others on this list. While I of course think that all of these companies that I picked will succeed, I'd be a fool to think that they will all for certain will. What I am willing to bet is that the aggregate return of all of them will be much better than the market. That's all to say that Ginkgo represents a solid risk-reward opportunity over the next decade, in my opinion, and I will continue to add to my position as I have been, especially in the low 4 range where we are currently. Next up is Recursion Pharmaceuticals. I expressed much of my thoughts around Recursion in my most recent video, so check that out if you're interested. Like the rest of these, Recursion has been crushed since IPO, but this has only allowed me to lower my cost basis further. Similar to Ginkgo, they have plenty of runway after the IPO. Recursion's platform has a ton of potential going forward to develop new treatments for ailments that wouldn't be addressed otherwise, and they are already making progress with 4 programs in the clinic already through phase 1 trials, and 41 more in early development following behind. The majority of these were developed in 2021, showing a drastic acceleration in their ability to create programs using their platform. And of course, I can't wait to see their Q4 business development release. A few of the things that I'll look for any guidance on is how quickly they will move their new programs into the clinic, and what they think of as their bandwidth for how many clinical trials they can run simultaneously. I'll also be looking for any guidance that hints at more partnerships coming, or announcements of new partnerships themselves. Finally, I've added to my Recursion position aggressively as it's gone down, and this will continue until I'm out of money. Next on the chopping block is Latch. Latch is down 73% from all-time highs hit last year after the 20+% dump on earnings. But again, with all of these stocks, you'd think that they were on the brink of insolvency with crumbling business metrics. Of course, this isn't the case with Latch having more than 1/3 of their market cap on their balance sheet in cash and equivalents. They also have accelerated revenue growth, with their revenue being up 120% in 2021 off an admittedly small base. Before the print, analysts expected their revenue to grow to almost double that rate next year off this still small but larger base, reaching $148 million in 2022, up over 250%. Even that was low compared to their SPAC presentation, where the company projected $173 million in 2022 revenue. However, and this is what caused the precipitous drop in my opinion, the company only guided for $75 to $100 million in full year 2022 revenue, much lower than the street and my expectations. However, the midpoint of this guidance would still leave Latch trading at 7 times next 12 months sales for a company that is growing over 100% this year and the next, and is selling 90% gross margin software installed on their specific hardware devices. And while revenue from 2021 is going to come in a bit short of where they projected in their SPAC document, this is only due to delays in building constructions with supply shortages and not something to do with the business not being strong enough. In contrast to the revenue miss, their bookings exceeded their SPAC presentation projections of $308 million and reached $360 million in 2021. This relative strength will be reflected in their revenue in the next 18 to 24 months as their bookings become recognized as revenue. However, they said that they will be moving away from the bookings metric to incentivize salespeople to optimize for real revenue, as well as because they will be focused on more second and third-party devices that will take away from the hardware revenue, but will still contribute to the long-term, high-margin, recurring software revenue. While guidance for revenue growth came in lower than expected, they made it very clear that there is significant room to the upside if supply chain woes alleviate, and that their guidance only includes incremental supply chain gains. Of course, you may start to notice a theme here, but I'm still buying Latch, even as it hits all-time lows this week. Arcturus Therapeutics is next up. Something I noticed when making this presentation is how much cash they have on their balance sheet compared to how depressed their stock has gotten, means that the company is only valued at a bit higher than the cash on their balance sheet. The most recent update was from the SVB Leerink Healthcare Conference, where management gave some remarks that were generally disappointing in my view. Management recognized that the booster opportunity is now the largest opportunity, as much of the world has already been vaccinated. I agree, and this is a good sign to see them making this recognition. They also guided they will complete their EUA filing in Vietnam in Q1. However, like they just said, the big opportunity is now booster shots, and they'll provide clarity on the path for regulatory approval for these in Q1. They also said that they may in contact with other countries' regulatory agencies to see what is required for approval after getting approval in Vietnam, both for boosters and first vaccination. Now for the bombshell, which is that they're targeting their first revenue from booster, and I quote, "if everything goes perfectly, next year." This was pretty disappointing to hear. I wish they had been able to drop the "if everything goes perfectly" and add an early next year, as this team has consistently delayed hitting their targets in the past, but has set the expectations now to be fairly low. What keeps some hope is that they may be able to drive some revenue from their primary vaccinations this year, and analysts seem to agree with me as the average estimate for 2022 revenue is still sitting at $170 million, according to Yahoo Finance. Nevertheless, there will still be a ton of potential value here, especially with star mRNA technology and all of the potency it brings with a small dose. For the third to last stock, we have Lemonade, which reached a massive under $20 per share low after the earnings report. Speaking of which, let me know if you'd like to see a breakdown of the earnings print and call, and I'll make a separate video on that. Lemonade has an absolute war chest of cash after the IPO and the secondary offering that gives them room to reinvest aggressively in growth going forward, in addition to a massive runway. Lemonade grew IFP 78% year over year in 2021, which is obviously a stellar rate. However, they are projecting this to slow to only about 40% organic Lemonade growth in 2022. This means that they are projecting the rate of customer acquisition, or rate of growth of premium per customer, to slow dramatically in 2022. This, of course, is pretty shocking, but I got the sense that management sees Metromile as already giving investors 70% growth and would have invested more resources to make Lemonade Proper's business grow more if it had not been for the Metromile acquisition. Again, with the closing of the Metromile acquisition in Q2, total IFP will be up 70% for the year in 2022. This would give a price to end of 2022 IFP ratio of just 2.5, which is insane for a company this early in their growth, in my opinion. Furthermore, as Lemonade continues to go lower, Metromile looks more and more like a steal, assuming they can still complete the transaction. If completed at today's prices, Lemonade would be paying less than $80 million in stock for $200+ million in cash and equivalents on Metromile's balance sheet, as well as over $100 million in IFP. Clearly paying less than a 1 price to IFP ratio and making $100 million in cash from the equity raise is a steal of a deal and makes me worry about the viability of the deal, which wasn't addressed on the call at all, but rather they confirmed their confidence in the deal going through. I'm still a buyer of Lemonade, although I held off in after hours until I heard management's comments on the call in the morning. After that, I added to my position slightly. There's one significant worry that is bothering me more and more lately with how much autonomy is progressing, and as I understand better how profound a step change this will be, I'm a bit worried about how this will affect their long-term growth. But keep in mind, Lemonade's management is aware of this and they will address this in the best way they can going forward. Lastly, check out another one of my videos for more thoughts on Lemonade and their valuation as it continues to get even more out of whack, titled Lemonade is Criminally Undervalued. Second to last is Invitae, down a massive 84% from all-time highs. And while Lemonade, Teladoc, and Latch are jockeying for the holding I'm down the highest percentage on, Invitae is solidly my total biggest dollar amount loser. While Invitae does have about 2 years worth of cash left on their balance sheet, they do have a net debt position due to convertible notes outstanding. However, I've never been more excited about Invitae's business itself. In a recent video, I detailed my thoughts further. I love to see Invitae launching new products, especially because these products will allow them to put in place flywheels that will drive new levels of value for patients, such as multi-cancer screening. Again, new thoughts in the most recent video titled, Invitae will be first to liquid biopsy. Of course, they are still leading in hereditary monitoring as well as expanding into other massive markets. Now to their financials, Invitae reported $458 million in 2021 revenue, up 64% year over year. For 2022, analysts expected 38% growth, and that was about in line with the company guidance of 40% revenue growth. If they hit that 40% revenue growth, that would place a forward price to sales metric at a little more than 3, which I find amazing for a company growing that fast with such a massive total addressable market. The company has said they will release short-term margin targets this year, which I think analysts will love. Management also said that this year they think they have reached peak losses, which I also think is important to allow their cash to give them a longer runway. In fact, they spoke directly to this in their Q4 report, saying they would burn about $600 million in cash in 2022. This would be a reduction from 2021 about $200 million. Finally, I'm still adding big time to my Invitae position, and I have over 5x my share count since the start of the crash. The final stock, which doesn't even really belong in this list with all of these unprofitable speculative companies, is Tesla. I just had to include it because I think it's hilariously underpriced. By my math, they are trading below a 40 forward PE, which would be expensive for a company with slow growth, but Tesla said they expect to grow revenues in excess of 50% per year for the next decade, with demand through the roof. As if this wasn't enough, they are on the verge of solving for autonomous vehicles, which will be one of the largest value creation events in history. And for the next leg of growth after that, they're setting up for the chance to redefine what human labor is with the Optimus robot. I think this is laughable to see their stock floundering with the rest of the market. Over what? Russia has invaded Ukraine? While it is terrible, Tesla doesn't have a factory there or really sell any cars. Are they down because of inflation? That effect would be mitigated by raising prices, as they already have. Tesla is a monster, and I can't believe it has been dragged down this way with the rest of the market. Good for us, though. Still loading the boat. Thanks for watching. What do you think of all these companies, and how are you holding up in the crash? Any moves you're making out there? Let me know in the comments below. Thanks again for watching, and have a great rest of your day.